What's up everyone, it's Karthik with MoneyVest. So Elon Musk just made a very bold comment essentially saying that America is going bankrupt. And this was 17 hours ago on Twitter, responded to another Twitter user that essentially posted an article headline that says, and I quote, "I'm glad that 76% of my income tax goes directly into important things like interest on past government incompetence. Interest payments on the US national debt will shatter $1.1 trillion this year, eating 76% of all income taxes collected." So there's a couple things that I want to clarify in this, of course, report. And I'm not really sure exactly how they calculated the 76% of income tax collected, but I really want to go over directly to the source, which is the Congressional Budget Office website, because there's since been a lot of chaos related to these types of headlines. And look, long term, I also do believe there is going to be a bit of a problem. There is going to be a challenge because every large country that's come into leadership has run up its course into 100 years, and then a new powerhouse has essentially taken over. The US is coming up to its 75 to 100 year anniversary as being the global powerhouse economically, military, financially speaking. And of course, their spending habits are quite unsustainable, as the head of the Monetary Policy Chairman, Jerome Powell, has also mentioned this. They've talked about the national debt time and time again. In fact, there's plenty of sources out there that can essentially tell you what is the national debt over in the US. Of course, we're sitting at almost $35 trillion. That is a pretty big chunk, for the US, because the debt is almost as much as the GDP. If not, I think it's slightly more than the GDP. But this is a very good sort of website by the US government. It's called fiscaldata.treasury.gov that explains to you how the national debt is calculated. Of course, if you're spending more money than what you're bringing in terms of revenue, you run a deficit, and a deficit keeps piling on every single year, and that is the debt. That's the national debt, which is broken down into public and private debt. And if you go down further, you'll notice that this right here is the overall progression of the U.S. national debt over the last 100 years, and it's gone from about $403 billion in 1923 to now we're sitting 100 years later at well over $33 trillion. So it is up not 10 times, but instead it's up almost 90 times from those levels to over 33, almost $34 trillion. And this right here is the debt to GDP sitting at 123%. And the average GDP for fiscal year 2023 was just under $27 trillion, which was less than the United States debt of $33 trillion. And this resulted in a debt to GDP ratio of 123%. Generally, a higher debt to GDP ratio indicates government will have to greater difficulty in repaying its debt as well. And you'll notice that it was, of course, much lower back in 1970s. It was much controllable under 40%. Then we saw a huge increase. And then this right here is the spike post the great financial crisis. So that was, of course, resulting in massive liquidity injection from the United States government, from the Treasury Department, from the monetary policy, Jerome Powell. Of course, back then, Jerome Powell was not in charge, but monetary policy injection of liquidity and buying back bonds, and again, providing a lot of ease of access to finances, resulting in increasing to 100%. And then, of course, due to the pandemic in 2019, 2020, huge spike going from about 107% to well over 127%. Now we're starting to come off a little bit from those levels. But breaking down the debt here, again, $27 billion is going to be the debt held by the public, and $7.2 trillion is going to be intra-governmental holdings. Overall, almost $35 trillion as well. And as they continue to run the deficits, issue more and more bonds, interest rates and the total debt. So this is the average interest rate. Now, this is also pretty concerning because as interest rates continue to go down, and something that I've mentioned before, in the last 10 years, you'll notice that it's actually gone from 2.4% to now sitting at 2.97, so almost 3%. And really the reason for why this is happening is because the newer bonds, the bonds that are now being issued, are being issued at a higher interest rate. And the reason for that is simple, because there is a big concern that is the US going to be able to repay all of that debt? And if there's a huge concern with that particular question, then investors are going to be more cautious. And if they're more cautious, that means less demand. If there's less demand, that means higher yields, because price and interest rates move in inverse to each other. If prices go down, yields go up. If prices go up, yields go down. And price in itself is a factor of demand and supply, right? So if there's high demand, prices are going to be higher, yields are going to be lower. If there's low demand, prices are going to be lower, yields are going to be higher, interest rates are going to be higher. And as a result, you'll notice that since 2021, we've seen interest rates go up from 1.6% on average to now sitting at 2.97% on a total debt of $33 trillion. That's a massive amount of interest rate. Now, some people may argue that that is still a really low interest rate, but it's not really the concern with regards to where we are with interest rates. It's really about where we're headed. Because if we continue to issue new bonds at higher and higher interest rates, that average interest rate on the across of all notes, all bonds, and the entire debt is going to increase, and that thereby increasing the net interest payment every single year, which you can again take a look at the Congressional Budget Office website. So this is the CBO, again, the analysis by the US Congress. Come over to the June 2024 report, and it'll give you the 10-year projections for the national debt. And what you'll notice is that this is going to be the revenue section. It essentially shows you how much the United States government is expecting to bring in terms of taxes, individual income tax, corporate tax, payroll tax. Everything's going to be laid out perfectly. So the total income for this year, for 2024, revenue-wise, just under $4.9 trillion from the United States government. And this right here is going to be the outlays, right? So mandatory, discretionary, and net interest. We don't have the breakdown. I wasn't able to find the breakdown in terms of the specific outlays. We do have a table over here, table 1 through 4, unadjusted, that essentially shows the Social Security, the major healthcare programs, Medicare, Medicaid, some defense budget, veteran programs, civilian military retirement programs, other programs related to education, agriculture. So you can take a look at specific line items as well. But if you come back over to the table, you're looking at mandatory expenditures over $4.1 trillion, discretionary spending of almost $1.8 trillion, and net interest. Net interest is the interest after whatever income is generated. So maybe it's my understanding that the headline over here, $1.14 trillion, is the gross interest that the United States is paying on its national debt, and that 76% is essentially taking into account the income taxes, like personal individual income taxes collected. Because if you do the math here, which is almost $900 billion in net interest expense, if you take into account this divided by the entire revenue, which is 4.9 trillion, we arrive at around 18%. So that's going to be 18% of the entire total revenue, which is income tax, corporate tax, and payroll taxes included. But if I take this number and then simply divide it by the individual income taxes of 2.4 trillion, of course, that number jumps to over 36, almost 37%. Now, if this number was 1140, which was $1.1 trillion, now we're looking at over 46%. So even then, it's nowhere near close to 76%. So it's kind of not known how they're calculating that number of 76%. But the bottom line is that this number is still higher, right? It's still, I mean, a third of income taxes are going, a third or about a fifth of income taxes are going towards interest on the debt alone. It's not going towards anything other than the interest, literally, quite literally the interest on the debt. It's not going towards infrastructure. It's not going towards new roads or new highways or new transportation, new healthcare plans, new education, new Social Security, new Medicare, none of that. It's simply going towards the interest on the debt itself, which is almost a fifth, depending on how you calculate it, a fifth or a third of the total revenue collected, right? So that definitely does suck if you do look at it that way, and of course if you are paying a big chunk of your income in taxes to the government every year. Now, this right here is going to be the percentage as a percentage of GDP. And what they have essentially laid out here is that 17.2% of the GDP is going to come under the revenues. In other words, the income tax, corporate tax, payroll taxes, everything that's collected is over 17.2%. And the total outlays are going to be almost 24%, hence the deficit of 6.7% of total GDP here. And that number they're expecting is going to hit well over 7.1% by the year 2033 because revenues are going to be 9.7, which is still increase, right, from 8.1 to 9.7, but the government spending is also going to increase by a full 1 percentage point to almost 15% in terms of mandatory, discretionary 5.6, so that is going to increase to 24.4 and 25.1% by the year 2033, whereas 18% is going to be the total revenue, income tax, and corporate and payroll collected. So that's going to be a deficit of over 7.1% as the national debt continues to increase, debt held by the public from 26 trillion to well over $50 trillion is what they're expecting by 2034. So this right here is the number, of course, not everybody wants to see, considering that is going to be a pretty big number of over $50 trillion. And if you simply apply an interest rate of, let's say, 3%, right, on that number, so we're looking at $1.5 trillion in interest payments every single year on that debt. And 3%, I'm actually being very conservative here, considering we're talking 10 years out to 2034. That number, the average interest rate that I showed you, could easily be well in the fours, considering that interest rates are going to be higher. Moving forward, we're kind of long gone are the days we're going to see lower interest rates, of course, unless there's significant deflation in the economy. But if you do get up to, let's say, 4%, now we're looking at well over $2 trillion in interest payments alone on the national debt. So this is definitely, in my opinion, an issue that needs a lot of attention. It is an issue that, of course, requires some level of insight when it comes to fiscal deficit, national debt, and fiscal responsibility, because this is a very unsustainable path, as what Jerome Powell has already mentioned, in his previous updates, and not to mention that even Warren Buffett, to some extent, did not really have an answer when asked point blank by a 12-year-old kid during the Berkshire Hathaway meeting that how is the United States going to come out of this huge burden of over $34 to $35 trillion worth of debt. And even then, Warren Buffett was kind of answering in circles, didn't really get to the point of how or when they're going to come out of this mess. So let me know your thoughts down in the comment section below. And again, this is not a video to sound the alarms or anything, but it's something to keep in mind, because Ray Dalio has written about this extensively on how the major sort of power plays happen over 100 years in a century, and how the sort of changing world order is one of his famous books, and he's talked about it, written about it extensively. So I think it's really important for us to be aware of what is potentially going to happen in our lifetime, because all the investors, all the great investors of their time have obviously taken advantage of the 100-year rally that we've seen, the progression since the great industrial revolution. We've seen a significant increase in productivity, in gross domestic product, in income levels, in wages, in stock prices, asset prices. Everything has increased, but the next 100 years may not be the same as the last 100 years. And that's really where we have to do the analysis and play it more smartly to better understand what is potentially going to take place in the next 100 years. So let me know your thoughts down in the comment section below. Hope you all enjoyed it and found it helpful. Make sure that you drop a like and subscribe to the channel. Also, don't forget, links going to be down below. And if you want to get access to the entire MoneyVest platform, links going to be down below. This right here is going to be the entire platform for your analysis. All the earnings have been released. You can access the earnings calendar. And of course, your individual stock analysis on a lot of companies. Go over to individual stock pages and again, conduct your entire fundamental analysis. Look at the MoneyVest metrics, fundamental analysis, analyst estimates, ratios. Everything's going to be available on the platform, including our discounted cash flow and discounted earnings models. So as always, happy investing, and I'll see you all in the next video.